Welcome everyone back to Pete's Investing Updates. In this weekly update of the indices and gold, we review the weekly progress of those every weekend. This week's summary, we're focusing on a change of the programming approach. So instead of using the 15-minute program, we're going to be using a daily chart to do our average down trading strategy, just comparing the differences and seeing which one may provide better results. As always, if you want me to review the material, any commodities or any other charts, please put them in the comments and I'll cover them in a future video. As always, click on the subscribe button, the notification bell and the like button to support this channel. First, let's review the playlists. This is where we review the indices each week. And then we look at the some blue chip stocks we review each week as well. And then a strategies approach that we take. And that's where this particular video will be published under this playlist. And in the strategies currently, we've got the simple trading strategy, the average down processes, which is what we follow, some money management ideas, etc. As always, we're not offering financial advice here. This is purely an educational video series to give you some better understanding as to how to trade yourself. First, let's get stuck into the results of what we're looking at in terms of the indices. Again, these are the 6 indices we look at, and gold. This shows the margins required for each contract traded, and again, that's dependent on your broker. As you can see here, there are a few $100s each for the Aussie 200 and the US 500. The German market's upwards of about $780. These are all in Australian dollars at the moment. You've got the FTSE. The China market requires the biggest margin of $1,639 per contract. And gold has got the smallest margin requirement at $90 per contract. Again, we're trading one contract. We're trading 5 contracts here, but this is per contract trades required. So if we're trading 5, then it'll be 5 times this. What this here shows is the profitability over the 5-month period. Again, this is comparing the 15-minute chart that we're looking at, and I'll show you the charts in a minute. And this shows the profitability, and they're all profitable with the exception of China, and I'll go to that chart in a minute. And this shows the maximum drawdown requirement. So the net result is a negative 10,000, thanks to China here. And the drawdown requirement is 27,000. So if we excluded China, that'd be 23,000 over $8,000 drawdown. And what I've done here is put in a percentage of profitability over the drawdown. So you can see there 2,900 over the 1,600 is 181% benefit over that. So what you're looking at trying to achieve, high percentage number, the better. So in this case, excluding China, for example, you'd be reaping $23,000 approximately versus a drawdown of $8,800, and that's 260% drawdown in percentage terms. Then we look at the rolling 5-month period on a daily chart, and very similar results for the ASX 100. Likewise for the US market. The German market has a bit less in terms of profitability, but also less in drawdown requirements. FTSE likewise, a bit less in profitability with no drawdowns required yet. The China market's still in negative there, and the gold market is reaping a bit more than the 15-minute chart. So overall, again, excluding the China market, is looking at 15,000 versus 5,000. So that's about almost 300% return over the drawdown. So what it's basically telling us is the daily chart would be a better prospect to use than the 15-minute chart in terms of profitability over drawdown. So let's quickly go to the 2 chart types. So I'm showing you here the big picture in terms of the 5-month view, going back to almost the start of March. And this is showing you the 15-minute time frame and the profitability for the ASX 200. So over the 5-month period, it's reaped $2,914 in profits for the ASX 500, and that's reflective in that figure there. The 1,606 is a drawdown requirement. I'll show you that in a second. The drawdown is basically from the highest of profitability to the lowest there. So that seems to be probably the biggest drawdown. So let's just measure that, see what that is. But we're looking at 1,606. The way that's calculated, this software program gives me the report, and the drawdown is 1,606. That's what I'm using there. But to do it in a manual fashion, let's just draw a ruler. Let's just see what that comes up to. So you can see there, that's just a rough drawing, it's 1574 in terms of profitability drop or drawdown. The others would have been a bit less than that just by eyeballing it. So you can see there 880 roughly, and they would have been similarly not as much as the other ones. So let's look at that one there, 940. So that, just by eyeballing it, that was the biggest drawdown requirement for that at 1606. Okay, so let's look at now that's the big picture for the 5-month view. Let's look at the daily chart. Again, this is the ASX 200 for a daily chart, and we started back here at the start of March. So what it's saying here is we're trading on a daily chart frame, and the profitability is 29.19, and again that's reflective in this point there with a drawdown of 1037. And I won't redraw the drawdown requirements to demonstrate, but basically that's what the drawdown means. So the ASX 200 is very similar for a 15-minute chart and a daily chart, as we said from that other table. Let's look at the US market for the two charts in comparison. Again, for the 5-month period, 28.19 for a 15-minute chart versus 22.04. So again, it just shows you the profitability differences. Now you can also see the number of contracts. 5 contracts were only required for the daily, and likewise we only used 5 contracts across the board for the 15-minute chart as well. Let's look at Germany. You can see here it averaged down at this point there. So it opened up on a 15-minute chart back here, went pretty much sideways and consolidated for a number of weeks, and then it doubled up, added 5 more contracts there. So we've got a total of 10 contracts at that point there before it closed out with a profit. Whereas the daily chart only used 5 contracts. So hence the maximum drawdown in this case was greater than, only because of China. And I'll cover China in a minute. But you can see there, excluding China being the biggest X factor there, this is showing a better result. Even with the negative result here, the higher percentage, the better. So in this case, minus 32 is a better result than minus 40. So that still is a better result for us to trade on the daily chart. Let's go to the FTSE. You can see this also had an average down at this point there, and we're still in a trade at this point for a profitability of 4,400 for a 15-minute chart. On a daily chart at 1634, so a lot less in terms of profitability, but it's also kept the 5-month contracts only open. Lastly, let's look at China, the one that's causing us the biggest headache in terms of profitability. So you can see here, since it opened up back here on a rolling 5-month basis, it closed out here at a small profit, went above our $100,000 baseline. Then it reopened 5 contracts there, added another 5 contracts there, and lastly added another 5 contracts there. So it's still open at a profitability of, so we're down from a $100,000 baseline, we're down to $66,000. That equates to about $33,000 in the negative in terms of drawdown. Whereas the daily chart, that's also in a negative, but it's up, only lost down to 75,000 from 100,000, so down $25,000 odd. And this only averaged down and accumulated 10 contracts only at that point there. Now, if this recovers back up, it goes up again. So again, our trading strategy in this example, we're trading the exponential moving average 9, breaking above the simple moving average 20. That's when we enter the contract, enter a new contract. So here you can see there the EMA 9 broke above the single moving average 20. We entered the trade. Now, part of our strategy is it needs to break down sufficiently before re-entering the market, and it did so there. And we're looking at doing so once it breaks above the moving average 20 again at this point, sometime in the coming days or even weeks. Then lastly, let's look at gold. So on a 15-minute chart, we averaged down a few times here, at single trades here, and then we averaged down again here when it dropped sufficiently on a 15-minute chart. It's currently still open at $325. Again, we're trading 5 contracts. Remember, each contract is $90 for gold. So it's currently sitting at 325 with a drawdown of 854. So that's only 38% profitability over drawdown, which is not a great result. We'd like to see over 100% percentage profitability over drawdown. Let's look at the daily chart. No average downs occurred. We opened up here and it closed out there. Okay, again, see that moving average, exponential moving average 9 over the moving average 20, and it closed out there. Had a nice little trade, and here it gained from 100,000. It gained $700 in a couple of months. So that's not a bad little trade for gold. The price dropped and it re-entered back here. Now we're still open on that trade, and part of our strategy again is we need to be making a 5% minimum profitability before closing out. So again, we're still open at this point, even though we're up on our initial entry point. So we're up here, you can see there, 755. We started at 710. So we're up about $40, but that's not enough according to our strategy. We need to gain at least 5% before considering closing out. Okay, so it just gives you a quick snapshot. And again, I've deliberately left China in there because I want to show the results of what happens if you A, trade a very high margin contract, and B, what happens if it goes against you with multiple contracts open. So the idea is you want to get higher profitability over drawdown requirements. So ideally, the higher the percentage, the better for your results. That's it for today's video. As always, click on the subscribe button, the notification bell to get updates, and like this video to support the channel. Thanks, and speak to you guys next week.